What's going on, guys? Anthony Angelillo, CEO, founder of Tag Lending Group and top originator for 2020 and 2022. Hopefully, we'll see. CEO, founder of Tag Team Nation Marketing Company, co-host of Damage Control with Melinda Grimaldi. And this is our 74th show. It seems like it's 740th show. There's a lot of information that it takes to generate these shows, guys. And with that, I'll introduce Melinda. Go ahead.
Hi, everyone. Melinda Grimaldi, real estate and title attorney with Grimaldi Law Firm and the Closers Title Insurance Agency. Super excited for another episode. Today, we're going to be, we talked last episode about the shift and the shift in general. Today, we're going to be talking about more specific changes that we're seeing in the deals, right? How is this shift impacting our transaction? And of course, how are other things changing? We every once in a while we do like an industry updates of what we're seeing changing through the process. There's a lot of condo changes, so we'll be talking about that. So might as well start there, right? So there's some loan changes, there's some title changes. Why don't you start explaining to us all what's new in the loan space for condo buildings?
So with deferred maintenance right now, that is going to be an issue coming up. And I believe that the Rock the Market announced this. And we had our little note taker, Natalie Rivero, taking notes saying that most of these associations now are going to require and mandate that the actual condos have 10% liquidity. What that means, folks, is that, now it's going to be actually a blessing, I think, in terms of the loans. But, you can talk about the title side, but at the same time, I think it will be a blessing because you'll have these Fannie Mae approved condos now that are 3% down rather than 25% limited review. And what the difference is, folks, is,
let's break this down, Anthony. What is deferred maintenance? You're talking about deferred maintenance. I just learned about this term this year, so there's probably a lot of people watching it and don't know what the term actually means, even though they know the concept. So what is deferred maintenance?
Any deficiencies that are under construction with the association. So if there's any, like if the pool right now has $10,000 or $10 million in deficiencies and contract.
What does that mean, deficiencies? Like there's repairs that need to be done? Let's keep it simple.
Tons of repairs.
The terminology simple. Deferred maintenance means there's things that need to be done and work on the building in the common areas that have not been done yet. Generally, it's not done yet because they don't have the reserves to do it.
They don't have the money.
And they don't have the money because they're not padding a little bit each month to that monthly to build their reserves.
And why is that?
Why is that? Is because they vote against it to do it. The owners don't want to pay more every month. So what happens is the maintenance and the upkeep and all that work gets deferred until it becomes a point of a breaking point, hopefully not literally, but where it must be done. And then at that point is where the special assessments come through. But the problem is that, we saw what happened in Surfside, right? Yeah. And so because of that, the state is implementing changes that they will not allow there to be so much deferring. So they're going to require, is my understanding, a little bit extra to start building the kitty. Like to build your kitty is going to be required. So you had that reserve. The thing is, there's going to be a lot of transition, right? Because there's a lot of deferred work already, plus to build up that's like that little bank account for future stuff, so that it's not going to be deferred to a point of a catastrophe. So we have that issue with the loans now. How does that impact when there's no reserves? We have a loan problem, right? Because it doesn't fit in all the puzzle pieces of the loan types that we have available.
Yeah. So when it's underwritten from a third party, okay, and the association doesn't have any liquidity, which would be 10% reserves, then it's required that the borrower puts down a larger down deposit. So you're looking in the state of Florida, they usually want 25% down for a primary home, as opposed to if they have reserves and they have the 10% threshold, then it would be below, that threshold. You could do 3% first time home buyer, 5%, 10%, 20%. So
this change in the law is going to allow us more loan options once things get settled. But as of right
I mean,
now,
I think it will drop. I think there's gonna be a lot of turmoil, to be honest with you. I don't know. There's gonna be a lot of special assessments, but I mean, at the same time, I think, yeah, within a year or two, you're gonna see it.
yeah, I think that exactly. So to get started is probably going to cause problems whenever it's in effect. I don't have that start date, but there will be new things coming up. There was some loan changes at the end of last year that started this year about this deferred maintenance. So basically, what's the 411 on that? Like right now, if a building has deferred maintenance, if there's, we all know there's a lot of no reserve. No reserves is not a new thing, right? But what's the change with the deferred maintenance as of the end of last year, beginning of this year?
So basically now the lenders need to go into a portal to see if there is a green light, meaning if there's any 40-year certification that has not been completed. And if there is a red light, we keep it simple here. So we're using green light, red light here. If it's a red light, you can't go in. There's a 40-year cert not completed. And you're not going to get financing per Fannie Mae. You could choose a non-qualified mortgage, which is going to be a higher interest rate. And obviously, those are non-QM loans and they'll take on something like that. But it's a larger down payment, higher interest rates. So per Fannie and Freddie's guidelines, if you go into the centralized portal and you don't have any completion of the 40-year certification, it's automatically dead. So the first thing that any listing agent, or buyer's agent should ask, do you have your 40-year completed? Is there any deferred maintenance? Any litigation against the condo association? Do you have, liquidity, things of that nature?
So speaking of 40-year inspections, since the Surfside collapse, there has been a change in how we're handling liens on the building. So the 40-year, so eventually if the 40-year recerts are not done, it'll turn into a lien on the building. If it's a lien on the building, every unit has that lien on their unit.
Yeah.
So so I'm finding that in running our searches and in the last few months, the county is quicker, the city is quicker to file the liens on title than they were before.
Really?
Yes. So there are many more that we're finding that they're not waiting as long because why? They don't want to be the ones responsible that didn't put the pressure on the building to fix their stuff, right? Fix their problems with their building, or make sure the safety is still working through this. Okay. So with that being said, even if there was a lien on the building a few years ago, we were able to get a sufficient funds affidavit from the association saying there's sufficient funds to put the property in compliance and pay this lien off. Well, now the underwriters are no longer permitting that. Things have changed. So I can no longer use that as an option. So the only option we really do have is getting the unit released from
and how
that.
long does that usually take, you think?
So not talking about a 40-year recert, because I don't know if they even are issuing it for that yet. We haven't gotten one back yet for that. When we had other types of liens, it takes weeks to just get sometimes the way to order it, right? So, and then it requires a seller to put money up front to order that payoff statement. Sometimes it costs about $1,000 just to get a statement. That's not even the actual fine itself to get the unit released. So we'll have to get this payoff statement. Usually it costs money to get this payoff statement from the city. Then from there, the payoff statement will have that unit's proportionate share of the entire lien, whatever that lien amount is in that moment. So here are the dynamics about this, how this works on title. The idea is why it's important on the unit is that it will turn into one day as probably a special assessment. And that's why it can be a claim on a title insurance policy if you don't properly address it. If it's a cash deal, the parties can negotiate, figure out what that's going to look like. And then this code enforcement issue becomes an exception on the policy. When there's a loan, that's the harder part, right? So because we can't have exceptions on the loan policy. We have had scenarios where we've been given permission in certain ways when we know that the building is working on the repairs. I've been given exceptions in certain scenarios where we give the buyer an exception and the lender no exception. And the buyer signs a hold harmless saying when the assessment comes through, I know this is not going to be covered. That's a case by case scenario depending on the lien and where it's coming from, the details, etc. We can still do, if the work has been completed and there are no more actual violations, we can use a SFA to say, yes, we have sufficient funds. We're going to negotiate to try to minimize the fines, and then we're going to pay it because we know that the fines will not keep accruing. Right? Because until your property is in, this is whether it's on the unit or on a house or on the whole condo building, if you have a lien on violation on the property, until that violation is cured, that it's usually a daily fine most of the time that's accruing. And that's why it says, well, sufficient funds for what? You don't even know how much you're going to owe because you haven't fixed everything yet. And that's why we can't use that option anymore. So there's a lot of things changing in that world. I think that, we're going through the pains right now, but I think it will get better because the laws are going to start catching up to what needs to get done. It is what it is.
No, I agree.
When I had a condo, I voted against that too. Like, that's just, no one wants to pay up front. I'll pay it when I have to. Why? I'm not going to make interest on my own money. Why do I have to give it to them to hold? I'll pay it when I need to pay it. But it is what it is, right? It is what it is.
Interesting.
So what else are you seeing, Anthony?
October, that rule is supposed to be in October to January, in between those times.
Cool. So we'll see how that plays out when the time comes. What else are you seeing?
So FHA announced gap of employment that will go into effect September, and basically they're taking notice on people that have gap of employment per COVID, right? And we all know that a lot of people lost their jobs. Okay, so what they're doing to strengthen the market and to make sure that we have a flourishing market is that they are now going to consider someone who makes, say, X 60,000 a year. Usually they would do a year to date average, right? And they would, have that aggregate number, and they would use the most conservative number. But in this case, they're just going to basically do 60,000, divide that by 12, and gross up that income. So that should help people that had a large, significant gap of employment being out for COVID. And I think that's awesome. I think that's going to help a lot of people out to try to, get them in the house. In Miami, especially, it's very difficult. The median income support in the inventory. We all see that right now. But this, every dollar helps. I remember when MCC, the mortgage credit certificate program, grossed us up to about 166.66 a month. That extra $166, possibly got someone into an HOA or not. It makes or breaks deals. So every dollar helps. That was announced about, I want to say, last month, and will be in place September. So that should help a lot of FHA borrowers. Medical collections are going to be removed. So that should help credit situations. And it will
That's
also,
pretty huge. A lot of people have medical debt.
I mean, they never really considered it anyway in FHA, but where it's going to be helpful is that when you're pulling credit and you're doing what's called a conventional conforming loan, right?
Mm-hmm.
When you run AUS, automated underwriting system, DU, it's called. Basically, this is going to allow you to have less credit layered risk, is what we call it. And basically, in layman's terms, if there's no collections, there'll be a greater chance to have someone get an approved eligibility going, conforming. And right now, everyone wants conforming products.
Yeah,
so
makes sense. So let's talk about rates. I mean, how are you I know obviously rates are changing every day. How is that impacting your business? Obviously, the higher the rate, the more expensive the loan. The more expensive the loan, the less likely, no, put it back the other way. So excuse me. We have to keep it. Sorry, guys.
Hold on. I don't know who changed it.
The double view is how it's supposed to be.
Let me see.
For the sake of the replay. All right, there we go.
There we go. All right,
There we
DC
go.
ladies, please leave it the way it is. All right, let's do.
All right,
Well,
so
rates.
if rates the cost of the loan is more expensive to get it, the monthly payments are more expensive, which means a buyer might no longer be qualified or qualify for less, right? Like bottom line, that's what's happening, right?
Yeah. Yeah. So right now, inflation report came out, and we have higher rates. Okay. And we're looking at, rates that are probably in the 5.5 range, where we were used to rates being in the 2s and 3s and 4s. Okay. And this just got basically announced this month, and last month. And we're going to have another rate hike, which would be September. All right. So I don't want to get negative on this. I get, there's so much, media that's saying, people are not purchasing right now. There's a 40% decline in mortgages and blah, blah, blah. So what I really think that people need to really understand, and the real estate world, especially, is that rates are not bad. All right, rates are not bad. There's two sections. There's wholesale and there's retail. And I don't want to get really, too detailed about wholesale and retail, but in layman's terms, think of it as like Amazon or Netflix versus Blockbuster. Okay. And so if you are a real estate agent, you need to really do your due diligence and protect your borrower, and ask for the loan estimate, not just some pre-approval letter. Really take a look at it to make sure that the rate is not, 6, 7, 8%. We're seeing really, really high interest rates right now. I know people are closing at like 6.8, 7% rates. And usually that's going to be a retail lender. Not to sit here and bash any retail lenders. It's just when I'm looking at a loan estimate right now, our rates right now are around 4.8, 5%, and retail is pushing up to about 5.8 to 6% because there's margin that they add on to it. And every business has to make money. But how much is that cost associated with that rate? And that's the things that we need to look at. Like when you're looking at that loan estimate and you look at the actual note rate, and then you see the APR, and the APR rate, the annual percentage rate might be higher. Usually there's going to be either discount points and origination fees, cost associated to get that, interest rate to be where it's going to be. All right.
Or it needs to be sometime, right? For that. So we're seeing those because of those rates, we have less qualified buyers, or buyers are qualifying for less as a general, right? So as that continues, that is impacting, of course, the demand. The demand is still there. It's just listings are not flying off the shelf before sight unseen within 24 hours with like 15 offers, right? So as agents, and from what I'm hearing is like, they're sitting on the shelf a little bit longer now, the listings, and there's less offers coming through. The above appraised value discussion is probably not going to be much more of something that's going to be happening.
Are you seeing that on your side? I'm not seeing that.
I haven't seen one in a few months.
Yeah.
So that is what it is, right? So, but then when if you're on the buyer side, contracts are starting to get accepted quicker now, right? Because there's less competition. So I'm sure on your end, you're seeing that big shift come through, where when you pre-approve someone, they're actually getting a property if they're qualified. Whereas like in the last 2 years, I think in the lending space, you guys definitely saw that kind of shift earlier with what's going on, because not only, yes, there was good rates and more qualified buyers, but there was not as many properties. So in that what do they call it, like a balance beam, or not balance beam, like a scale, you had that, but then there wasn't the properties to match it. So the amount of properties to match it. So there were some other point is basically at Rock the Market, they gave a few other market stats. They don't envision property prices. These are some of the leaders in our state. They're not envisioning that the property values are going to be tanking. They are going to settle. There won't be some huge growth that's coming through. And then one really good point that they made, which we'll see how, especially in the winter months, how this is going to look like, is the market that we've been dealing with was based solely on local American Florida demand. It was not based on
Yeah.
what we usually see in Florida, coming from other countries, South America, Canada, et cetera, et cetera.
Yeah.
Why? Because of COVID, because of travel restrictions, because people were uncertain of what was going to happen. So now that the borders have been opened up, we're going to be seeing a lot more tourists in,
More
and then that
nationals.
demand should be coming in, and we should be seeing that that floodgate start to flow a little bit more. And then, you know, as an agent, what you're going to be doing, you're going to have to work a little harder, actually probably a lot harder than what you were doing to get your listing sold. It's probably going to be easier if you have a qualified buyer to get them under contract. So that's where, you know, the pendulum will balance out a little bit for agents. You know, you just got to make sure you keep prospecting, because since there are less qualified buyers, that's where, you know, that's where you're going to have to make sure that when you do get a lead, you keep it, don't waste it, by not following up and doing what you need to do. So continue to prospect. Or those are my last few takeaways for the day.
Yeah, there's look, the rates are not significantly higher. I don't want to sit here and say they're in the 7 or 8s, but think of ways, I should say, to try to make the deal work, you know, and a lot of these borrowers that we're dealing with right now, most of them are living with family, right? And so that's a great question that I would ask as an agent. Hey, you know, is mom, dad, aunt, uncle going to be, you know, living with you? Okay, so we're seeing that on our end, and that's that. So
excellent. Any final thoughts or takeaways, Anthony, before we wrap up for today? On rates or any other changes you've seen? Because I know you had a couple. I think we hit all your points, but check it out if you have anything else you want to add.
I don't have anything else besides we talked about medical. Yeah, everything else is good.
Excellent. So that's a wrap for today. We some of our episodes are going to be longer. You'll see some of them are more straight to the point with a summary of what we have going on for the topic. We'll be starting to have more guests on, so stay tuned with everything that's coming up very soon. And we look forward to seeing you on the next one. Have a great day.
Thank you. Take care.
Bye-bye.